Hello everyone, I'm Gayathiri from Index One and I'm joined by Chris McHeffey and Cmiel from BX. Today we'll be discussing why alpha investing plus tax loss harvesting equals total alpha. A primary goal of any investment strategy is to generate alpha, but can you do this while also maximizing the benefits of tax loss harvesting? Can these two objectives work hand in hand, and could there be an index blend out there that's designed to tackle both challenges at once? Tax loss harvesting is a wealth management strategy that can boost after tax returns by realizing investment losses to offset gains or income, thereby deferring or potentially reducing tax liabilities. This allows more capital to remain invested, giving it the opportunity to compound over time. In this session, we'll explore a practical blended tax loss harvesting approach that doesn't just aim to reduce taxes, but also seeks to capture alpha. We'll walk you through three purpose-built models developed by BX and calculated by Index One that are designed specifically to meet this dual objective. We'll have time for questions after the presentation, so please feel free to submit your questions in the chat box as they come up. With that in mind, Craig, could you walk us through the key ingredients of a successful tax loss harvesting strategy and share what BX focuses on when designing a tax loss strategy, particularly when integrating alpha?
Yes, thank you, G. The the evolution of tax loss harvesting really evolved in mainstream U.S. wealth management about 5 or 6 years ago. And what I mean by that is the big custodians and big asset management companies like Schwab, Fidelity, BlackRock, Morningstar created solutions where a financial advisor could go into a portal, select an index like the S&P 500, customize it or whittle it down, and then send it to the execution order management system where some fewer number of stocks would be purchased, less than the 500 that they started with due to the deselection or customization process. So that's really the fourth column. So the evolution of the industry, one day you just had stocks and then all of a sudden mutual funds were born to give people pooled investments. What was born out of that were separately managed accounts, which essentially were mutual funds, but the stocks were actually in a separate account. And then that brought of that were exchange traded funds, where essentially you had the same basket, but it traded on an exchange to give you greater liquidity. And the negatives of all of those were, they just weren't very tax efficient and you couldn't really control the tax outcome. So that's where direct indexing came in and basically said, hey, if you're really interested in capturing losses, you really need to have a separate account that's built with a big basket of stocks that the engine is continually harvesting the losses and replacing those things that they're selling with a placeholder. At BX, we felt there was another evolution, which is this active indexing, which is rather than just starting with pure beta, i.e. the S&P 500, could you have some beta and some active or alpha into your basket, delivering what we call, investment alpha plus tax alpha. It's interesting to look at this calendar year where the market had a very strong first quarter, a very weak second quarter, and a very strong third quarter. It's really a perfect environment for tax loss harvesting because so many of the things that investors owned in March and April and May were at losses, because the market had a 15 to 20% pullback. So if you started the year with like one of these, just a tax loss harvesting strategy, you would be capturing a lot of losses this year. But on average, you could expect to earn 3 to 5% in tax losses based on all the studies that we see.
Awesome. Thanks, Craig. I will pass it on now to Chris. Chris, BX has developed three tax loss harvesting models: the BX Global Tax Loss Harvest Portfolio, the BX US Harvest portfolio, and the BX Defensive Harvest portfolio, which are all being calculated by us at Index 1. Could you walk us through these models, explaining what they include, why they're designed to generate alpha, and how they make effective tax loss harvesting solutions?
As Craig had mentioned, building baskets with a large number of securities is kind of important for tax loss harvesting, because if you own hundreds of stocks, you're going to have losses to harvest kind of along the way. So what we wanted to do was create a globally balanced portfolio, in this case, that each sleeve individually outperformed its own benchmark, and the blend outperforms any sort of global benchmark. And the reason that total alpha is so important is, for example, if you were to compound at 8% for 20 years, you're going to wind up with 4.6 times your money. If you compound at 11% for 20 years, you're going to wind up with 8 times your money. So that's 70% more in your retirement pot, or whatever it is that you're saving towards, by generating that extra 3%. And we think that that's very doable. In fact, we design our models to try and deliver 3% plus of pure investment alpha. And then you layer on another 150, 200 basis points of tax alpha, you could wind up with 5% outperformance. But even conservatively at 3, you can see what a gigantic kind of difference that makes. So you can see in this portfolio, there's a small cap component, there's a mid cap component, there's several US large cap components, and there's an international large cap component. So we built this portfolio purposely the way that we typically do, which is to find outperforming strategies that don't have particularly high correlations to each other to produce great risk-adjusted returns. And in this case, there's 350 names in the total portfolio, which will give clients a really significant opportunity to tax loss harvest along the way. So you can scroll to the next slide. You can see the US harvest portfolio looks very similar, but it obviously doesn't have the international component. But what it has is the Index 1 Mega Cap 50, which is a very good, just pure US beta play, right? So that's giving you, very core exposure, and you can, skip over to the next. Now, what's interesting about these portfolios is some of these sleeves are actually exact clones of PSN Top Gun SMAs. It's just that when you ingest them the way that we deliver them, you can tax loss harvest it instead of just handing over that control to a money manager. And you can run it through a vehicle like Alphathena and realize your losses kind of along the way. This portfolio was built with a very different objective in mind, which was to be defensive. And you'll see when we get to the results, we really did, this portfolio really would have protected very, very well on the downside. So the US harvest portfolio, because it's got, all cap US exposure, we thought it was best to benchmark it against the Russell 3000, or the proxy for the Russell 3000, the IWV ETF. And you can see it's generated really substantially better performance than the Russell 3000 over the past 5 years. You can scroll to the next one. So you can see it's generated almost 400 basis points of that investment alpha, but you're not really giving up. In fact, you're taking less risk to do it because of the way that we constructed the portfolio with the lower correlations among the sleeves. So you can see the annualized standard deviation of 17.8 versus 21. That's reasonably significant, and the maximum drawdown is actually smaller, which is something we almost always try to deliver when designing portfolios. Maximum drawdowns are obviously clients' greatest pain point. So, the results of this kind of speak for itself. You can see the global harvest portfolio on the next slide. We thought that ACWI was the most appropriate index to compare it to, because it's just all the stocks in the world, basically. Once again, you can see some pretty significant outperformance over time of the model that we delivered. Once again, 350 names in here, so ample opportunity to realize that tax alpha along the way. Next slide. Right, so you can see this portfolio has generated exactly 300 basis points of investment alpha. So that's always one of our intentions versus the ACWI. So once again, you take that 300 basis points, you add 200 basis points of tax alpha, and you're having a really significantly better experience. You can also see the standard deviation once again is lower, and the maximum drawdown is almost identical. So lower standard deviation, much higher return, 350 stock model, significant outperformance. And then finally, the defensive portfolio. We benchmarked this one to the ALR ETF simply because it had the identical standard deviation. So we thought it was a good benchmark. You can't compare a portfolio like this that's built to be very defensive to, say, the S&P 500 because the characteristics are so much different. And you can see the results on this slide, on the next slide, where you'll look and see the standard deviations are in fact identical, but the returns are 500 basis points. The returns are 500 basis points better. And in this case, as I mentioned, we built this to be defensive. You can see that maximum drawdown of 14% versus 21 for the growth blend is really substantially lower. So this is one where your client's time to recovery is going to be much, much lower than in a similarly volatile vehicle. And that time to recovery is a really important statistic because your clients typically want to be at their high water mark, and the amount of time that they spend under it is a time of discomfort for the relationship. So that's kind of just a quick look at some of the portfolios that we've built. We can work with any advisor team to kind of embrace whatever goal they're trying to achieve is. So these are available, kind of off the shelf, or we can work with you to customize something that maybe even suits your particular needs better. So I mentioned AlphaThena. AlphaThena is a very strong partner of ours, great financial technology. They have a wonderful tax loss harvesting engine where you can set your parameters on your tax rates, your minimum short and long-term losses, your minimum in both percentages and in dollars, because taking $5 losses doesn't really help anybody. So you set that number at what's appropriate and what's going to be impactful given the client. And one of the great things about AlphaThena is connectivity to the custodians. So you can actually connect your client's actual accounts to AlphaThena, embrace our models, run them through the tax loss harvesting engine, and have them executed at your custodian, all without you having to do anything after the initial setup.
Chris, maybe just a couple of follow-on points. One thing that makes what we're going over today very different is we're talking about essentially a UMA versus an SMA to start the process, right? So the vast majority of tax loss harvesting, direct indexing is done with one basket. And in this case, we're bringing in 4 or 5 different sleeves to create a UMA, or what we call a model. And so what you get are the benefits of the diversification in correlation matrix of bringing in different styles and strategies. So that's one big difference. The other thing that we've learned over time is that in these types of strategies, specifically tax loss harvesting strategies, it's good to have active strategies, but it's also good to have some beta strategies. In this case, we have a mega cap 50, which we like a lot. That gives some stability. The other 4 sleeves in this case are all rebalancing roughly, or reconstituting roughly quarterly. And so that's where the active nature and alpha comes from. For us, an active manager has to also be able to deliver alpha on a consistent basis. Otherwise they wouldn't be one of the sleeves that we would select from this. And so it's really a unique approach to say, can I take the other thing that we look for is to have at least 50 holdings per sleeve. One, we want to have enough diversification in there, but we want to have enough ingredients in there that we can actually harvest the losses without disrupting the performance. So we think the ideal number of holdings for harvesting or tax loss harvesting portfolio is like 300 to 350. Because once you get beyond that, you start to eat into your performance and you're just really doing tax loss harvesting. So we're excited about this. We work, as you can see on this slide, we work with Global Beta. They have a market light strategy. Syntax has both the defensive index and a moat index, the PMV downside defenders. So this blend of these 4 does a really nice job of keeping the risk down, but still generating outperformance. In our U.S. Harvest portfolio, we work very closely with Financial Trust and their mid-cap, small-cap phase invest, their dividend yield plus momentum, and as well as the large cap core, and then the index one mega cap 50. And then the international is similar, where we're looking around the globe to find managers who can deliver better risk-adjusted performance. So, G, I'll turn it back over to you.
Thanks, Craig, and thanks, Chris. So what exactly does Index One do in all of this? Index One serves as the index calculation provider for the BX strategies that we've discussed today. And these strategies give advisors additional tools to address clients' short and long-term investment objectives, including alpha generation and tax loss harvesting. As the index provider, we collaborate with advisors and investment strategists across a wide range of themes, asset classes, and factors, and we continue to see innovative approaches emerging in both funds and model portfolios. The BX indices covered in this session are among several indices that we calculate for BX, which are then combined into index blends to meet a range of client investment goals. So we're very pleased to play a role in bringing these strategies to market and help advisors support their clients' financial objectives more efficiently while continuing to foster innovation in indexing strategies. So all of the BX models discussed in today's session are available on both the BX and Index One websites. If you have a strategy that you'd like calculated in real time as an index and potentially integrated into other portfolios, please feel free to reach out to us. We're now moving into the Q&A portion of the webinar. Please feel free to submit your questions in the chat box and we'll address them as they come in. But in the meantime, this question is for the both of you. Typically, you're using a smaller number of holdings, but it seems like this approach is different. What is the thought process behind it? And I know you mentioned it before, Craig, but is there an optimal number of holdings that balances diversification with the ability to harvest losses effectively?
I'll just say one more thing as a follow-up to what I said earlier, which is important to note that when you think of like an active basket, it really is a separately managed account. And a separately managed account has a portfolio manager sitting on top of the separately managed account. And historically speaking, they don't like it when people come in and say, let's trim this, customize that, or tax loss harvest this. So I think that's also another key differentiation of starting with a broad basket where the performance can adjust relative to like what a house SMA performance might look like. BX currently has 65 indexes that we calculate at Index One, the smallest of which has like 1 or 2 or 3 holdings, the largest of which has like 130 holdings. So one of the things we look at is like, hey, it's too hard to tax loss harvest a 10 stock sleeve or a 15 stock sleeve. It's also sometimes very hard to tax loss harvest a real active portfolio. So to us, we want it to have some turnover, but not a ton. And we want them to have at least 50. So then it depends how many sleeves you have. So if you've got 4 sleeves, that would be 200 total stocks. The stuff that the strategies that Chris was showing earlier all had 350. So we think that's a good number to really maximize the stocks that you can sell and capture the losses.
Thanks, Craig. Okay, I don't think that we have any questions that's come up. Do you both have any closing remarks before we end the webinar?
The other thing I was going to say is Chris had shown Alpha Athena earlier, which we were fully integrated with tax loss harvesting engine at Alpha Athena. one of the things that we look at when we're looking at different tax loss engines, and there are a number of them in the industry, is what do they do about replacing the stocks that they're selling? How are they coming up with a replacement strategy? Are they putting money in cash? Are they putting money in an ETF? Are they finding the next best security? So we think the Alpha Theme has a really nice system to give financial advisors and their clients an optimized way of not sacrificing your performance by finding the best replacement security. So we think that's important because you don't want to unnecessarily be loading up a lot of money in ETFs or loading up a lot of money in cash just because you're doing tax loss harvesting. You want to stay true to your goal and purpose. So that's what we look for, is like, what is the best replacement security mechanism when you're running security stocks through a tax loss harvesting engine.
Awesome. Thanks, Craig. Okay, well, thank you everyone for your time and participation. Be sure to subscribe to our email newsletters to stay updated on our next video content. Thank you all for tuning in, and we look forward to seeing you next time. Thanks, everyone.